the ranging market and also the downtrend, okay, or what we call the consolidating market. So today we are going on episode number 2, okay, episode number 2. Leader Kenneth has the package. He has the full package. Make sure if you didn't watch, if you didn't attend lesson number 1, if you didn't attend episode number 1, make sure you go to our YouTube channel. Our YouTube channel is Earn Money Online the Easy Way. That's the YouTube channel. Make sure you visit that YouTube channel. Woo! Hey, you guys, I'm fired up. I'm fired up. Okay? I'm fired up. If you don't know our YouTube channel, make sure you check out Earn Money Online the Easy Way. That's the YouTube channel. Make sure you check out episode number 1 if you didn't attend episode number 1, or if you missed, make sure you watch episode number 1, because what they're going to teach today, it is an addition to what was taught yesterday. So make sure all the videos are available on the YouTube channel Earn Money Online the Easy Way. That's the name of the YouTube channel. Go there and you go to the live section. If I may show you here, let me share my screen. Okay, just a few minutes here, 1 minute, 2 minutes here. I share my screen. Go to YouTube. Okay, go to YouTube. If you come to YouTube, look for this channel. Look for this channel called Earn Money Online the Easy Way. Earn Money Online the Easy Way. Now you come and touch where it says View Channel. View Channel. That's where you should touch. View Channel. When you click on View Channel, you can see we have all the lessons. Even this one is already live. Come here on live. Okay, you want to be interested in live. Okay, when you click on live, you'll see all the lessons that have been done live. You can see even lesson number 1, episode number 1, which is of yesterday, has already been uploaded. It's already there. So you can watch this lesson, then you continue with this one of Smart Money, episode number 2. If you missed this one, the first one, make sure you watch it again. Make sure you watch it again. Make sure you grab your pen and paper, write down all the notes. That said, let me welcome aboard our great leader. But before I welcome him aboard, I have just 2 announcements to make. One, Leader Kenneth produced a book called Smart Money Concept by Leader Kenneth. He goes into much more details on how you can use the smart money concept and trade like the banks and trade like the big banks. It combines smart money concept with ICT, so it has much more details than the ones you're going to get here in the lesson. He told me that he is going to be leaving out some of the key setups that you may get from only his book. Okay, he is the guy who has read it for long. He is the guy who has experience. He's the guy who has been on the market for so long. He understands what he's doing. Make sure you get a copy from Leader Kenneth. Leader Kenneth, please put your number in the comment section. Put your number here in the comment section so that people can reach out to you. You can get yourself a soft copy if you're very far. If you're near, you can get yourself a hard copy of the book. You can get a hard copy of the book. Get Smart Money Concept book and make sure you make a lot of money from the setups that are shared within the Smart Money book. This is the number for Leader Ken. You can just reach out to him. Those of you on YouTube watching this from YouTube, you can reach out to Leader Ken on this number. That is one for the Smart Money Concept book. But if you prefer him to coach you personally, if you prefer him to hold you by hand and take you through all the smart money concept plus the ICT plus all the big strategies he uses, if you want one-on-one mentorship, he also offers that at just $100. At just $100, you can send in your email at that email provided. Also, you can connect him on the number provided. If you need one-on-one session and you need him to hold you by hand, take you through a one-on-one session until you become a professional, he offers that at just $100 per month. It is small money. It is a small investment compared to the amount of money that you're going to make in the long run. So make yourself that investment. Buy the Smart Money Concept book. Get him on one-on-one at just $100. My dear, you will never regret. As per now, he is already having a team that can that he is already coaching. But if you want his personal coaching one-on-one, where he dives deep more, he dedicates more time to you as an individual, that's just $100 per month. It is small money, small investment. Get your copy at just $25 of the book. Then we continue. Help me, and we clap our hands together, and we welcome Leader Kenneth. Let me see some hands. Let me see some reactions. Let me see some hands. Let me see some hands. Let me see some hearts. Okay. Wow, 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 wow. Wow. All those are for you, Leader Kenneth. He's a guy who's providing us free information, not paid for. But if you want him one-on-one, and you want him to hold on your hand, hold you by hand, and take you through from beginner to a pro trader, it is just $100 per month. If you want his book, which has big setups, clear setups, make sure you reach out to him. Just $25 at this number, here. Get him through. He will take you through. He'll give you the book. He'll deliver it to you. Make sure you don't miss this opportunity. Welcome aboard, my able leader. Leader Kenneth, welcome aboard.
Thank you, Leader Dixon, for the opportunity once again shared to me and being given all the powers to share a little bit of what I know in the markets, of which I think if any of us, as per now, we are 144 people, whereby if I could sit in front of these people and share a little bit of what I know or of what I've experienced in the market, it will at least change some stories. It will make some of the people profitable, and some of the people won't be profitable if you don't give in your time and the energy. Because I took my time, I studied, I invested in the little I could by then, which I think is now so good to me that I can sit in front of 147 people to at least share. Okay, I know where you are now. I've ever been there. Okay, and actually I've ever been to a situation that is even worse than this. Like in that state of being saying, "Oh, will I manage? Will I manage?" The market is so hard. But if you give in your time, invest in the knowledge, because we're here as a group. But when you sit back in your own place, you're going to find that you have to act up as soon as possible. We are leaders, true. We're going to provide you with the knowledge. But if you don't act upon the knowledge, okay, there is nothing that will come to you. It's all about those who win big, put in the investment. The investment you have is your head. Once you get this skill, more especially the smart money, because all other traders, all other concepts that are derived from the market are all based on smart money. And if you're using smart money, you know what to do and where, why, and when to enter and exit the market with proper precision, with valid reasons. If you don't have a reason to place a buy or a sell, then you're not in the market. You don't have a reason. But if you learn the smart money concept, you're trading like someone who has $1 million, though you also have access to trillions of money in this market. All right. So, without any further ado, without going into much details, my name is Kenneth. Once again, I've been trading for so long, not so long, like so long, but I'm sure the time I've spent here in the financial markets is worth me coming up and share with some of the people that have been there for so long, some people that have been there for so short, those even that have tried out stuff and have failed. Okay, still, this might be a turning point. If you invest in your time and proper understanding to the financial markets, this could be a turning point. Okay, so without further ado, let's dive into a continuation of what we had looked at yesterday. Let me just share my screen first. Okay. Let me hope my screen is very clear and visible. All right. Now, from what we looked at yesterday, we were looking at market structure, the mechanical, the textbook type of a market. We looked at it in the sense that it had three directions. We had the bullish market, the consolidating market, and the bearish market. Okay, for anything to do with structure, no, deny. For anything to do with structure, I think we looked at it yesterday. Okay, we looked at it yesterday, but there are some key points you should observe when marking out a break of structure. Acamper, please. When marking out a break of structure, when mapping out a change of character, when marking out a protected low, a protected high, a swing low, a swing high, a higher high, there must be reasons, there must be proof, okay, to show that those areas are valid. Now, when we start with a bullish market, because a bullish market, we all understand that a bullish market is only and only proved to be in an uptrend if it is breaking structures to the upside. Okay, we have this, we have this point, we have this, we have this. The proven data we have is that we going to say that we are in an uptrend. We need to see markets forming. This is a high, this is a low, sorry, this is a low, this is a high, this is a lower high, or a higher, this is a higher low, not a lower high. Higher low, then higher high, another higher low, another higher high. This is the proof we have. This is the data that is already proved to indicate the market that is moving upside, whereby if the market is moving upside, we have all rights. You have all rights, you're guaranteed all rights to come through into the market, see where the market is going, and do what? And place a buy, not a sell. If the market is going up, you have to place a sell, sorry, a buy. If you don't see that you're able to place a buy, okay, please leave that position. Go find another asset to trade. There are thousands and thousands of them. Though, when trading still, do not trade more than maybe 20 assets. 20 assets are enough for you. The market will always give you a chance to take profits from it. If you align with it, it's going to give you that chance. Without further ado, let's go. Now, for us to have this as a break of structure, there are some rules we follow to have it named a break of structure. Same thing, we have rules we follow to have this named as a valid break of structure. We have rules to have this as a valid break of structure. You could say, what are those rules? The rules are so simple. It's a matter of having to say that if the market is in a bullish state, okay, it would come here for me having a low, a high, a higher low, then a higher high. As we talked about this, you cage your trading zone, okay, in the sense of waiting for the market to break the highest, the recently formed high or higher high, okay. So after caging this move from here, after caging this move from this region to this region, okay, we had a pullback. Our pullback is not supposed to go below our protected low. Why is it called a protected low? It's called a protected low because for us to continue in the state of being in an uptrend, this market has not to close below this line. Okay, that line should be protected by the buyers so that it could continue going up. But if it does something like this with a valid reason, that could be a change of character. That means the ceiling, sorry, is it the ceiling? No, this is the floor of the market has been broken, but it doesn't have to get there. That's why we come and stop there. Now, after catching this, you're going to draw a line here, straight line, and wait for the market to break structure. There is something here that you should observe to have it as a valid break of structure to the upside. All right. Please, Micho, could you leave my screen? Now, so this reason here is only one reason. If we get to have a candle, a body of a candle close, I'm zooming what you need to find here. Okay, let me put an arrow. This is something you need to find there. It's here. I'm going to write it here. You need to find a candle close above that line, in a sense that if this is our candle, you need to find something like this. The body, the full body close. You need to find a full body close above this line. In short, it must be something like this. All right, it must be something like this. All right, are we together? I'm taking you to the chart for us to have some region as, let me push to 4H. He who is writing my screen, when I land on you, I'm going to remove you from the meeting. For us to say that this is a valid break of structure at this point, when we draw our line from here, from the highest point we can observe from here, we draw it this way. Okay, it has to come and close. It has to come and close. You see this? It must close below, like this candle. You see this candle? Let me just highlight here. You see this? I need you to observe only here. You must have a candle close above the recently formed high, right? You must have a candle close above, with the body above the recently formed high. You get the point? Now, if we could go to 15 again, where are we writing our stuff? Where are they? Is a chart. Sorry, we can still do another one. No, sorry. For us to have a valid break of structure of this sort, we must have a candle close above this swing high. Right? What do we mean? It must look like this. If this is our candle, it must close above that line. Okay, like this. This could be called a valid break of structure. Okay, for this to be called a valid BOS, it's an abbreviation for valid break of structure. Okay, for you to come up and say this is a valid break of structure, that is something that has to be put into consideration. This, it must be a candle. I repeat, I emphasize, it must be a candle close above the recent high formed. Okay, after that, there is this other scenario whereby it's going to look like this. Okay, sorry. This scenario where it's going to look like this. Then you get a candle coming through here to close above this point of view. Okay, but it doesn't close. Okay, it doesn't close below here. It does something like this. It wicks out. This is called a wick. If the body of the candle, let me do this. If the body of the candle does not close above here, then this is an invalid break of structure. Are we together? From the reference point, let's go to this book. When you look at certain page here, all right, you're going to see that for a proper, look at this green arrow, proper BOS, there is a candle close above this line. For this point, for this reference, Gerard, please, at this reference, you can see that this, we drew our line, but we did not have a break candle. We did not have a candle close above. Right? Are we together? We did not have a candle close. We did not have a candle close. We did not have a candle close. My voice, I think I'm audible enough, right? We did not have a candle close above this line. We had just a wick. There is a wick and there is a body. Those are two different things. There is a wick, there is a body. Those who have been studying about candlestick formation, I think Leader Dixon taught about this. When we have a candle, okay, let's say this, that's our candle. Now, this is our wick. These points are called wicks. These points are called wicks. The body is this, okay? The body is this, not the wicks. If it's a wick, if a wick crosses onto the body like that, that is considered to be a valid break of structure. If it doesn't close like this, then that, and it closes like this, that's not a valid break of structure. That is something else. This is called a liquidation. We shall get there. Jared, please don't do that. This is called a liquidation. That's not a valid break of structure. Same story. For us to have a valid change of character, for us to have a valid change in state of delivery, like this, like this, like this, then this, okay? I'm just showing you the textbook structure of how the market moves and what you should look for to consider this as a break of structure. Valid break of structure, valid break of structure, valid break of structure. If you're observant enough, you're going to see that our lows are not surpassed. We're instead surpassing the high points, the high ends, not the low ends, right? Now, you see this? This low is a protected low. Still, this low is a protected one. This is a protected one. This was a protected one until this move went through this leg. Okay, now you cannot look for buys here. You have to look for sells. Same story. If we have this come and liquidate, not break of structure, but do something like this, if it comes and does something like this is called a liquidation. Okay, this is called a liquidation, not a valid change of character. Okay, this is called a liquidation, not a valid change of character. Okay, this is the textbook structure. Now I'm going to show you how you can go about the complex part of it. I hope you understand. I hope we've understood this part. Okay, have we understood this part? Okay, have we understood this part of a valid break of structure and a valid change of character? Sure, you've understood so far so well. Okay, good. All right, now let's proceed with there would be kind of complex part of market structure that is simple when you observe it. Okay, you're going to have this move, then in between this point and this point you're going to find that you have small breakout structures, breakout structures, breakout structures, then suddenly breakout. Gerard, I've talked to you but you don't want to listen. Mr. Dixon, you here? Let me first remove this guy. I think he's going to no, I think I can put you off for the better. You don't listen. Whoever is please writing in the screen, I'm going to remove you directly because we cannot be presenting and you start this. Let's find another screen to share. Is all well? Is everything visible? Is everything visible? If it's visible, write for me one in the chat. Okay, well, let's move. We are going to have the kind of complex part of the market. This, then we see these moves, we suddenly break out, we come back, we see this, we suddenly break out, we see this, and suddenly break out. Now, when you're using a higher time frame, let's say you're onto the 4H or the 1H, okay, you're going to experience something like this. And if you ever go to the wrong side of the market and you're like, okay, now this is a protected low, now this is a high, then this is a change of character. Okay, you'll be stopped out very many times. You have to follow the trend in that you can analyze or you can get to know that the market on a higher time frame, let's say 4H or 1H, is an uptrend. Okay, but when you're moving down here to your premium zone, to your premium or discount zone using a Fibonacci. When you draw Fibonacci, I'm going to show you how to use this for Fibonacci. Now, when it comes to market structure, you're going to mark out this region as your break of structure. Anything between this as we cage here, anything between in here is an internal structure. Okay, anything in between the swing high and the swing low is a what? Is an internal structure, right? Anything between this and that is an internal structure until we get to a point whereby we are breaking out of this region by this. We're breaking out of that region by that having a valid break of structure. When we get a valid break of structure, we change the trading range. Okay, that means our trading range has been from here up to here. Now another trading range is from the lowest point to the highest point. Still, you come through, cage it from this point to this point. Your expectation is always the market to come, you get where to enter from, and run away from that position. That means you entered from around here. Okay, you entered from here, then pushed up to break this point. Okay, anything you see in between here and here is internal structure. Okay, anything you see between our trading range is internal structure. Are we at par? Are we at par? Write for me one in the chat if we are at par, because I don't want to take you at a pace that you could not afford. I want us to go slow, understand, and we have a reference. Since I have a book here which will act as our reference point, so I don't want to report. Don't report. No, this will be our reference point. Okay, you can grab this, you read before we even come here. Okay, so that by the time I'm here, you will conversant with everything you need. As I go through, you will know, or you will equipped with the countdown of what I'm talking about. Now, let's proceed. When you reach here, you're going to have a point of entry, okay, whereby your point of entry in the discount zone. This is what we call a discount zone. I'm talking of a discount zone now. When you have 1, 2, 3, 50% of this price range of this, so we called our trading range, 50% of it is the premium, and another 50% is the discount. Okay, I'm giving you an example. Take an example. If we have 3 oranges, one that is costing us 1183 USDT, okay, and another one that is going to cost us around this region 1121, and another one that is going to cost us 1026 USDT, and all our selling points are at the top here. Sorry, let me put again. Now, all our selling price should be or must be at this point, at this 1-3. Okay, so of the 3 oranges, which one would you come to the market to buy and then sell later at this profit? Would you choose one here, one here, or one here? Let me mark these points. I need to see that answer in the comment section. Okay, you have orange 1, orange 2, orange 3. Okay, so of the 3 oranges, which one would you buy and sell it here at 0.4 and make profits? Which of those would you come to the market to buy? I need an answer, please. Which one would you come to buy? I'm seeing a lot of orange 1, orange 3, orange 1, orange 2, orange 3. Now, look at this. Look at the prices. Orange 1 is selling at 1035 USDT. Orange 2 is selling at 1121 USDT. Orange 3 is selling at 1181. But all of you have to sell at 0.4. You do not have to exceed orange. Sorry, you do not have to exceed 0.4 for you to sell. What does it mean? A wise man will not rush to buy at this price. Okay? A wise man will not rush to buy at this price because it's very expensive. It is at 1182 USDT. Orange, then the wiser man will still not rush to buy at 0.2. Why? Because it's still expensive, kind of expensive. Because this person knows that there is a chance for me to buy cheaper. Okay? There is orange one that is supposed to be bought at the cheapest price. Okay? Then the wisest man will not buy at either of these or at any of these points, but will instead come to the market to buy at 0.1. Why? Because it's the cheapest. Let's measure. Let's prove. Let's have proof. Orange 1 from orange 1, sorry, from orange 3, if you're selling to 0.4, you're making 11% of the money you invested in the orange. Okay? Now, the person at price 2, or the person that is willing to buy at 2 will almost harvest 17% of the money he invested. Let's say if all are buying oranges at $100, you have $100, okay? Now, when we get to 0.1, okay, this person will harvest 26, almost 27% from the money he invested. Okay, now this is how the smart money works. The smart money will always stop you out, will always liquidate you, push the price forcefully to a certain level where things are the cheapest. After pushing you there, it buys, and after buying, it sells at 0.4. The aim of smart money is to first take you out of the market, have that money absorbed into the market, because when you make an order, they liquidate you, they hit your stop loss, or they hit your take profit. Okay? That money is absorbed and put into the market. All right? That money is absorbed and put into the market. So when it is put into the market, there is someone who you aligned with to buy your order in the order book. All right? So the smart money will always push the prices down here, down to this level, in the so-called discount zone, which is 50% of that trading range, and then stop you out. If you entered from around here, they stop you out, they liquidate you, then the market eventually moves up. Their intention is to buy at the lowest price and sell at the highest price of the price range. That's where we bring in our Fibonacci. This Fibonacci will always show you the highest price, the highest point of the price under the 50%. Let's draw it here. You stretch from your lowest point to your highest point. Now, our 50% is around here. So that means anything in between this region, okay, in between this 50%, anything in between here is cheaper than anything in between here. Your role is to buy at the cheapest price and sell at the highest price. Right? So that's what will happen. Let me get clean this chart. The market still comes down, sorry, the market does this. It comes down after breaking this structure here. It comes down, does not go past this level, but comes down, takes you out. That means your role is to enter from this region, since you know very well that if I cross below this line, okay, if I cross below this line, I will have the so-called a change of character. We're going to the live the charts. We're going live the charts. Okay. I want you to observe this. I want you to be very, very, very observant. Okay. Now, we had a market that was going up and down, up and down, up and down. Okay. Look at this. We had the market that was coming here. We had a break of structure. Our next expected thing to do is to either protect this low. Okay, protect this low, but we did not what? We did not protect it. That means the market was to go down. Okay, as we waited for the market to come and retrace so that we could buy things at the cheapest level, it did not, but instead caused another something like that. Still, we were waiting. What's the market going to give us? The market came here. This is the leg 1, 2. When we cage this, if we cage this, okay, we are waiting for a breakout. The breakout happened here. That means we had a valid break of structure up here for the market to go up. Okay, the market came through and broke structure. Okay, after breaking structure, that means our protected area was this. Our protected area, or the lowest point it could do, swing low, was here. Okay, in that swing low we have something called an order block. I'm coming to those order blocks. That order block is here. Okay, that order block is here. You may not understand an order block until I explain what an order block is. This market still retraced down. Let me replay this. Maybe it would make more sense if replayed. We were here. We broke structure. Okay. This was a break of structure, a change of character, and then we waited for the market to come down further more, this, to break this point. Okay, or to either break this or this. We waited for the market to come either break this, have another go down, or a go up. Look at what the market did. The market came, it went up, instead of breaking down here, it broke up here with a valid break of structure. When you draw from here to this region, you see that this is a valid break of structure up. Okay, how do we define a valid break of structure? We have a candle close. You see this? We have a candle close above this line. This is proof that the market is going to still go up. Okay, now when we get that break of structure, we wait and see. We have an imbalance here, we have a breaker block, sorry, an order block down here. Okay, now let's wait and see what the market does. After breaking this point, this market had to push down to pick things, or to pick those orange at the cheapest price, which is here. When we have our Fibonacci, we draw like this, you're going to see that our cheapest price is from this region 50% to down here. So this is our 50% below. We go. Let's go with the market. The market comes down, gets into, it will come to the cheapest price, gets into this region. Okay, there's a reason towards why I drew this. I'm going to show you why. Then after it gets in here at the cheapest price, our next break of structure would be here. Okay, that means after buying from here, super entry, you don't need to wait for anything, and unless you wait for a confirmation down here. We're going to go down into confirmations as well later. Now you expect the market, after getting you buying from here, the market is going to come through and break up here with an assurance. It will not get below that line. It will have to directly go up and break. That means if you entered from here, your take profit was here. With what percentage? You entered from there, your percentage was 15%. Clean money. Even if you get 2 trades in a week, you're done. You don't need more. You don't need to fidget and fight the markets. No. Are we at par? Are we at the same pace? Are we at the same pace? All right. Now, when you have a price range, 1, 2, 3, you're breaking structure. Okay. You're breaking structure here. What reason will for what reason will the market come back down to pull back and go up? There is something called imbalance or inefficiency or inequality in the market. Where's my thing? Laura, and I'm going to remove you. Stop tapping your screen. When you're buying or selling, there will be something called a fair value gap. That has a lot of names. A fair value gap, inefficiency, inequality, anything that does with showing injustice is this. Now, when you break structure, okay, when you look through this price leg, you're going to find yourself that you have something called an imbalance down here. Okay, what is that imbalance? How does it look like? An imbalance is a combination of 3 candles, whether red, green, any color you think of, so long as it's something like this. If you ever meet something like this in the market, okay, let me stretch it here. Assume these are our candles. Assume these are our candles. Okay, they are moving up in a direction, in one direction like this. But if you watch closely, you're going to find that in between these 3 candles, in between these 2 candles, candle 1, candle 2, candle 3, in between, let me mark them out so as not to confuse you. This is candle 1, this is candle 2, this is candle 3. If you watch closely, if you're sober and watch closely, you're going to see that in between the first candle and the third candle, there is something called space. These wicks are not interconnected like this. They are not, I'll show you. These candles are not interconnected like this. Okay? These candles are not interconnected like this. But there is, when you look like at it like this, you're going to see that candle 1 has a wick, candle 2 has another wick, okay? Candle 3 has a wick, but there is no space between this wick of the first and the third candle, okay? There is no space in between there. Even if you draw a line, there is no space. But when you look at what we drew previously, you're going to see that in here, there is something called a fair value gap, okay? There is something called a fair value gap. Let's find the reference. The reference is here. A fair value gap is the price gap that occurs when there is a big difference between the closing price of one trading period and the opening price of the next. You see this? Whether red, this is in a bullish state, red is in a bearish state. Okay? Now, these points are points where you should sit and wait the market to come to so that you can engage or you can be part of that flow. If we are in a bull, are we still in? My power had blacked out. Are we at par now? I had blacked out. Masanzege Uganda because are we still in? Okay, you can hear me now, all right? Yeah, okay, let's proceed. Let me share my screen once again. The screen is visible, all right? Now, this was a reference point. You're going to find that we have when the price gets up there, when the price moves rapidly from this region up here, it's going to create something called an imbalance within here, okay? That imbalance, the market comes back to fill this imbalance. So your position, you should wait for the market to come down here to take or to be part of this market to go up here and break structure. All right, you should be part, you should wait and be part of this market to come here and take the profit. Now, why does it come here? It comes here for the other reason I told you. The market always looks for the cheapest. Okay, it has to move down to find the cheapest prices. You should know where does that market get to find those prices that are cheap. It always comes to the prices where it left the imbalances. This market is like a taxi. It can never move up to its destination when it's not full. This market has to be balanced for it to proceed and continue to where it is supposed to go. Right? So if you come and stand at this region, in this market, it will step you out because that's not where you're supposed to stand. You're supposed to stand around here to come and pick you up. Now, if we mark this region, if we mark our imbalance as a fair value gap, okay? Now, the candle that led to this move that created an imbalance here is called an order block. Okay, this candle 1 is called an order block, or any region where a lot of money. An order block is a region in the market where there are a lot of money, where the smart money started involving itself in the market. When the smart money is involved, when the big people are involved, with the big money, with the hedge funds are involved into that trade, you cannot tell, but you can see that they are there. How? By these imbalances. These imbalances are the clues, is the proof that the smart man is involved. So you should not be trapped that the market now has started moving. You enter because you might have an inefficiency around this region. Okay, there's something called an inducement. You might have an inefficiency around this region. The market comes, okay, the market comes, starts testing you to see are you strong enough to wait for me to come to the region where I'm supposed to come. It tests you up until it lands into your region and boom, goes up there. When the market lands in here, remember there's something called time frame alignment, which you have to also follow. If the 4H is bullish, okay, if the 4H is bullish in black, okay, our point of interest is around here. Another point of interest is around here. Okay, guess what will the 15-minute time frame be doing? The 15-minute time frame will also be having its own break of structures. Okay, will also be having its own break of structures. When it gets to a point where the market is to pull back, it will have a market structure shift and then move like this. That's the reason why you get into the market and get confused. Like I'm saying, the market now is moving up, now the market is moving down. It's all about time frame alignment. When it gets to this region where it's supposed to move, okay, it's going to do a market structure shift again and proceed up like this until it comes to this region, breaking the structure here, coming up. When it starts pulling back, still it makes another market structure shift like this. This is the pattern that will always be in that movement in the market. So it's up to you to learn this language. You converse with the market, you see, you entice it, you tell it, please, I need some money, how can I get involved? It's going to give you those footprints. If you follow them, you're making the money already. If you don't follow them, you're becoming the money that other people are requesting for. Right? So this is all about time frame alignment. If the 15 minutes is moving down, let me see the color. If the 15 minutes is moving down, that means the 4H is making just a pullback to come and fill the imbalances in this region, okay, to go up and break structure. When it breaks structure, it again comes down. After this break of structure, the market still gets down to come and fill that imbalance, okay, and then move up. This will be the same cycle over and over again. If you don't practice this like this on these charts, you understand. If you go to the charts, it will even be worse. But you start with the mapping, this textbook structure. You understand where the market goes. Why does it go there? Why does the market have to come back down here? You well know, or you well confident that the market now is moving down to fill the imbalances here, to fill the fair value gaps, like we had seen it here. We had seen it somewhere here. Is it? We had observed it somewhere here. We had seen it somewhere here. Now, if this market is, let me do this for you. This market is moving straight like this, like this. If you go to the 15 minutes, do you know how much breakout structures are in here? Do you know how much downtrends are in here? They're there. Let me show you one. Now, when you look down here, you're going to see this. Sorry, not that. You're going to see this move. This, pull back, go up, pull back. At the point of reversing up here, the market makes the so-called internal market structure shift. You look for sales, the market comes back to look for the cheapest. It sells down here. That's how the 15-minute was behaving by then. Okay? You can see this bigger picture. 4H is bullish. All right. If it's bullish, what is happening to the 15 minutes? 15 minutes is bearish. You look 1, 2, 3, 4, 5, 6 change of character. When it changes character, I want you to be very observant. Next time I'm using a bigger screen. I need you to be very observant. Okay? In that in this region, after this break of structure on 15 minutes, we had an imbalance here. The market still came and involved itself in that imbalance. Okay, look at this. The market came here and filled the imbalance, even if it just pips there. That means orders have already been filled. It goes down when Xiaomi, please. Don't trigger me up. Now, it comes and goes down to this point. When it gets to this level, it rises rapidly here to break structure. After this break of structure, still the market comes down. Okay? When it comes down, now, if you break above here, let me show you this. If you break above here, this low becomes a protected low. But as the market was coming back down, it what? It broke structure. It did a break of structure. Okay. Sorry, a change of character down here, but it did not proceed to go down still. Okay. Now, this is where the market gets crazy and you're like, the market is hard today. You had one setup, you made 14%. These other days have refused. They refuse, days refuse. And you're like, today I'm not trading. I'm not seeing any setup in the market. You just sit and wait for your other setup. Because if you had $100, you're well equipped with this concept. You can make this 14% in a move. 2 trades a week are enough for you. I repeat, 2 trades are enough for you a week. I think time is not on our side. we can have a few questions here and there so that we close up for today. Okay. So I would like to welcome a few questions. If you don't have anything written down, you're wasting time. If you have something written down, right? Bravo, you're adding something onto yourself. Let's proceed with the questions. I'm just welcoming 3 questions. Then we call it a night. Ask to unmute. Mr. Jovan?
Well, good evening, my leader.
Good evening, sir.
Okay, thanks very much for the course tonight. It's been so interesting, and of course, I've learned a lot on addition to yesterday's or the previous course. Yeah, it's just been so good. Yeah, that's the only thing that I want to ask about is, can I please, is it possible to apply this knowledge on spot trading as well, or it only works on this side of future, or I need to go for a different section on how to apply it on spot?
This very strategy is used in futures. This is why. The futures market and the spot market are 2 different markets. All things that govern the spot market do not govern the futures market. Let me show you. Let me give you this as an example. Let's say the market is getting bullish. Okay.
Oh, yes.
In the spot market, if the market comes and changes character, okay, changes character here, it's up to you to sell or to hold forever until the market rises again. Okay. If you don't sell, there is no way that money is going to get involved into the market. All right.
That is in.
But in the futures market, if your entry is around here, okay, the moment you trigger, you either have to sell at a profit or a loss as a must at some level. If you don't sell, they will sell for you. If you don't sell, they liquidate you. If they liquidate you, more money comes into the market.
Okay.
Okay. So the price movement in the spot market is solely based on people's emotions. Okay. But the markets, the futures market, is solely based on how much are you trading, how much is coming in, how much is being absorbed every minute.
All right.
Another issue I've seen about that, if you're selecting an asset to analyze, right? Let's say
Yes, sir.
when you come here on your trading view, there are many types of assets you're supposed to analyze. We have spot, we have swap, we have features, we have index, and we have fund. Sorry. And we have fundamentals. Okay. So, oh God. If you analyze a spot trade,
Yes, sir.
and then place it in a futures position, you're wrong.
Okay.
If you're choosing a futures asset, the asset you're going to analyze in the futures market, it must have something like P, which means perpetuals. This
Sure.
P,
Right.
if it's not there, just know you're analyzing a different thing and it's going to eat you up. You're at the verge of slaughtering yourself.
Okay.
If you want to analyze spot, go to spot and analyze spot, Ethereum. Let me show you that actually, let me show it to you here. I want you to be observant and see how this market is moving. Okay. This is the spot market on 4H Ethereum USDT. All right. Now look, have you seen it?
Yeah, I'm following.
Now,
I'm following it.
Look at how Ethereum is behaving. They kind of look the same, but different volumes. If you look at BTC, let's see BTC. They kind of look the same with this, but totally different. BTC. We're going to analyze the spot market. We're going to see the spot market in Binance. This is how spot in Binance looks like. And you see, when you analyze this, this is BTC USD.
Okay.
Now we have Binance USD, BTC, sorry, not Binance, BTC USDT.
Is there those for hours?
There are different assets here. If you analyze one and you make a wrong decision, you're taken out, you're doomed.
So this means I must make sure that if I'm analyzing USDT, the BUSDT, not USDT, then I trade the USD.
You get the point. You do not have to analyze the USD and you trade the USDT. You do not have to analyze BTC USD and then trade BTC USDT perpetuals.
Okay.
Yeah.
Must
Because
be
the market structures are very different.
So then hope to catch up with you so that you give me some lights about the spot trading aspect as well. Soon I'll be catching up with your number in a privacy. Thank you very much, my leader. I'm so happy.
You're welcome. Mr. Gibbs, next.
Well, good evening, leader.
Good evening, sir. How are you?
I'm okay. Now, my question is, do we enter the market from the fair value gap or we enter the market from the order block?
Any of the two can work.
Now, another
Depending
question.
The two work depending on how you've entered, what you see, how the market is behaving.
Okay. Yep.
When there is a big momentum coming through to the markets, okay?
Yeah, sure.
You do not need to risk and enter into the fair value gap.
Yeah.
Let me show you. There are some trade entries. You see this? Trade entry with value gaps. Market structure, listen, liquidation, break of structure, market structure shift, 50%. If the fair value gap is very long, you enter at 50%.
Okay.
Now, your entry is placed here, 50% of that fair value gap. You can see that this market came through. It did not get to our order block, okay? But instead, in between our fair value gap, it was very big. We had a very big fair value gap.
Yep.
You entered 50%. Now, when you look at this, there is a very small and tiny fair value gap.
Yes.
Right?
Yep.
So at times you may want to wait for the market to come to your order block. If it doesn't come there, that means you've missed a trade.
Okay.
You just wait and see. After it's, you see, look at this. After it had jumped into our 50% of the fib, okay? 50% of the fair value gap. It started moving down. Look at the momentum candles, very big and strong. So you get ready to end around this place, around here, because of the momentum those candles are bringing up.
Yeah.
Right?
Right.
Now, look at this point. Look at look at the momentum it came with, then it started shrinking. The momentum shrinked here, tapped in here, and then the momentum shrinked good enough. We had a bearish engulfing candle here that engulfed this. You enter from around this region. Then you proceed with
Well,
move.
well, yeah, that's understandable. Now,
Okay.
I see other people, when entering the market, let's say you've been analyzing the market, like in a 4H, to get the fair value gap or the order block, they change from 4H, from a bigger time frame to a smaller time frame. What do you
That's
say
what I
about
showed.
it?
That's what I showed here. There's something called time frame alignment. If the 4H, okay, if the sorry, let me change here. If the 4H is bullish, okay, we
Yes.
expect to enter from some point here. Okay. Now, if this market starts moving down like this, we are waiting for something on a lower time frame called a market structure shift. Because if you see very well observe, we had said this is how the 15 minutes is going to behave,
Yes.
right? When it gets there, it changes character. Why does it change character? It changes character to move in the same direction with a higher time frame. That's why
Yes.
that's why you switch. That's the confirmation you're looking for from a higher time frame as it gets to our point of interest. Here, do we have a market structure shift? Yes. When you get a market structure shift, it's going to look more of the market has been moving down 15 minutes, then it changed character, still, then went up. Your entry will be on a market after market structure shift. This 15 minutes is going to as well give you an imbalance down here to come, fill, and take your direction at this point here. But those are entry models. Of course, we're going to look to them at a later stage.
Well, thank you so much, leader.
You're welcome. No any other question? Please just allow me to close up for today till we meet tomorrow. Okay? He who wants the book, you can inbox me. That's you can either use my email or my personal phone number. It's +256. Because everything we're talking about actually it's there. Tomorrow is the weekend. Oh, sorry. Then we'll repeat on Monday. 7 plus 256 707 830 226. That's my personal number. That's my personal number. The book is 25 USDT. The book is 25 USDT only. Let me tell you a story. I lost money before I understood this thing. I lost money to the extent that I didn't even have rent. I lost money until I sat down in the corner of my single room and I was like, dang, this thing must be serious. I have to sit down and learn. So you have to give it time. You have to give it time and learn. This is a skill. Even if they take everything from you, all you need is internet, a phone, a laptop, and $100. You build that empire they destroyed. So please, see you on Monday, not tomorrow. Tomorrow is the weekend. We have to rest. You have to chop some of the money we've made throughout the week. So I'll see you guys till we